The drop itself caught many people's attention. Silver took a sudden dive, and the speed of the move surprised even seasoned market participants. What followed, however, was just as telling. Buyers stepped in aggressively, particularly for bullion products. Within a very short window after opening, the showcases were effectively empty. When asked about the demand for 90% silver, the picture was more nuanced. That segment continues to sell steadily, especially to collectors and budget-conscious buyers who are stacking gradually. Dimes and quarters remain an accessible entry point. However, the largest buyers, those deploying significant capital, were almost entirely focused on pure bullion. That concentration of demand is what drained inventory so quickly. In one instance, a buyer walked in without notice carrying a cashier's check for a substantial amount and purchased whatever was available to reach his target allocation. Transactions like that have become more common during periods of volatility, and they leave a visible impact on inventory levels. Looking at the display cases, the effect was obvious. Entire sections were empty. A few items remained, some government-minted coins, a small amount of gold, and scattered rounds. But overall availability was extremely thin. Despite appearances, buying activity had not slowed. If anything, the opposite was happening. Metal was being purchased almost as soon as it came through the door, often before it could even be placed in the case. This type of activity reflects a market where demand is immediate and persistent. Buyers are watching price movements closely and acting decisively when dips occur. As prices rebounded toward previous levels, it became clear that volatility remains a defining feature of this environment. Silver, which briefly traded near the low 70s, moved back toward the upper 80s and low 90s. Gold also recovered, moving back toward the $5,000 range. These swings underscore how quickly sentiment can shift, especially in markets driven by both macroeconomic developments and liquidity conditions. Some sellers are now beginning to reappear. After missing earlier opportunities to take profits, certain holders are choosing to sell into strength. At the same time, buyers remain active, creating a two-sided market that reflects uncertainty rather than panic. As for why the price fell so sharply, several factors likely contributed. Expectations surrounding central bank leadership played a role, even though the appointment itself does not take effect for months. Markets tend to price in future policy shifts early, sometimes well ahead of their actual implementation. Beyond that, straightforward profit-taking cannot be ignored. Anyone who bought silver even a short time ago was sitting on gains, and periods of rapid appreciation often end with at least a partial reset. There was also discussion around large institutional positioning. Major players appear to have used the sell-off as an opportunity to exit short positions near the lows. That behavior is not unusual in this market and has been observed repeatedly over the years. The fact that prices rebounded quickly afterward suggests underlying demand remains intact. What stands out in this cycle is that the rally does not appear to be driven by a single event or narrative. Unlike past episodes where one dominant force controlled price action, this move reflects a combination of inflation concerns, currency stability questions, geopolitical risk, and renewed interest in tangible assets. That kind of broad participation tends to produce more durable trends. Another development worth watching is the introduction of smaller silver futures contracts. Historically, the primary contract size was much larger, which limited participation. While smaller contracts increase accessibility, they also raise questions about whether price discovery becomes easier to influence. More contracts, smaller size, and higher leverage can amplify volatility rather than reduce it. In contrast, physical holders remain focused on direct ownership. Many buyers prefer full ounces, bars, and clearly denominated weights. The simplicity of pure bullion makes valuation straightforward, especially compared to constitutional silver, where calculations involve conversion ratios and varying wear. For those thinking about eventual resale, liquidity, and ease of pricing matter. There is also a perception that fewer refiners and dealers are actively buying large quantities of 90% silver at the moment, which may be influencing preferences. That said, demand across all forms of silver remains present, particularly during price weakness. Another notable trend is the influx of new participants. Many people entering the market openly admit they are unfamiliar with precious metals but feel compelled to learn more. Media coverage has expanded awareness, and silver's price action has drawn attention well beyond traditional investor circles. With that comes enthusiasm, curiosity, and sometimes urgency. Experienced participants often encourage patience. Questions are welcomed, and while there is no shortage of silver in the broader sense, the desire to buy immediately is strong. For many, the appeal is not just financial, it is also about understanding money, history, and the role precious metals have played for thousands of years. Despite the recent drop, the broader performance of silver remains strong. Even after the correction, prices are still significantly higher than where the year began. From that perspective, the pullback looks less like a collapse and more like a pause within a larger trend. Looking ahead, expectations remain divided. Some believe the reaction to recent policy developments is already fully reflected in prices, clearing the way for a continued upward trend. Others expect more volatility as markets digest new information. What seems clear is that silver continues to move quickly in both directions, and large daily swings are no longer unusual. Historically, silver has shown the ability to move sharply higher in short periods, just as it can fall rapidly. Psychological price levels matter, but once they are crossed, buyers tend to adjust quickly. Having already experienced triple-digit prices, many market participants are no longer anchored to past benchmarks. Whether prices ultimately move significantly higher will depend on a combination of macroeconomic conditions, monetary policy, geopolitical developments, and investor behavior. For now, the market remains active, liquid, and highly responsive. For participants, the focus remains on discipline. Cost averaging, sticking to a plan, and understanding risk are essential. Volatility creates opportunity, but it also demands patience and perspective. Silver continues to trade as both a commodity and a monetary asset, and that dual role is likely to keep it in the spotlight.